I think there is tremendous upside potential in these stocks from here. And I think at the end of the year, people who did not buy gold and silver stocks here are going to be kicking themselves. Gold is going to be very expensive. Right now, it's almost 5,000 an ounce. 47, it'll be 10,000 an ounce. It'll be 20,000 an ounce. And even though gold and silver have already moved up a lot, they're not going to stop rising. As I've been saying, what did I say once again? Buy on Friday, buy on Saturday. Don't wait till Sunday night to buy gold. Don't wait till Tuesday when the U.S. markets reopen. James Rickards is saying they want to push it to 24,000. Do they? Will it? I mean, maybe. Who knows? All I'm simply saying is that's how you devalue the dollar. With gold already approaching historic levels near $5,000 per ounce, many investors assume the move is over. They strongly disagree, arguing that rising prices are not a signal to exit, but evidence of a much larger monetary reset unfolding in real time. They explain that gold's advance is being driven by deliberate currency debasement, expanding debt, and the long-term erosion of dollar purchasing power. From this perspective, higher gold prices are not speculative excess, but a mathematical consequence of policy decisions. Projections ranging from $10,000 to even $20,000 gold are framed not as hype, but as reflections of how far currencies may need to be devalued to restore balance. Silver and mining equities are presented as leverage beneficiaries of this trend, with the potential to outperform as investor participation accelerates. The message is clear. Those who hesitate now may look back with regret as tangible assets continue repricing higher in a system that increasingly relies on dilution rather than discipline. If you found this helpful, like, share, and subscribe to the Metal Bar. Turn on the bell so you don't miss any updates, and comment below to share your thoughts on it. Appreciate you for tuning in. Now listen to the interview, and I think that's what's happening also right now with the European banks, because they're the ones supposedly on the hook. Now that's Tom Luongo's theory, but if you look at a report that just came out, Economic Times, they claim that JP Morgan has flip-flopped and has went long, has covered a 200 million ounce short position in silver, bought 21 million ounces over the last 6 weeks of physical, and largely and the rest of the U.S. banks, the big five, are long, leaving one or two of the banks in your neck of the woods and a couple in Europe massively short. So as the price goes up, who is getting squeezed on this? This is very different deal than it was in 2011. This is about national sovereignty. And when you have the European Union, the United States, and China effectively say that we are rushing to accumulate this stuff and classifying things as critical and openly using it, like the BRICS are, as a settlement vehicle instead of treasuries. In other words, use gold to settle imbalances in trade and in currency. That's part of the bridge. That's part of what they're doing with the expansion of the Shanghai Metals Exchange. They're opening vaults all throughout the Belt Road. The first one was built in Hong Kong, where if metal leaves, gold leaves, China has to come out of Hong Kong. Well, the way they're doing it is they're trading their digital yuan over the SIPs or the bridge to a country like Saudi Arabia, getting their oil, and that digital yuan is now immediately convertible into gold off the Shanghai Gold Exchange in Hong Kong without converting to dollars. Guess where the second exchange is being built? Saudi Arabia. And they plan on doing multi-jurisdictional vaults all throughout the Belt Road, creating a system where you trade in local currencies, settle in balances in gold. Gold is being integrated into the monetary system globally, and silver is flat out critical for a world that is advanced, and I think they are prioritizing that now. And that is what's different, is that now it's not as big of a secret to the people who are pulling the strings as it once was. And these countries are significant enough in wealth and in sophistication to challenge this hegemony that where no one stood for delivery. And If you do, you break the system, and that's starting to happen right now. Gold and silver, on the other hand, were way up. Gold was up about 160 since Friday. We closed almost at 447 and 58 is the last I'm looking at it. We closed on Friday at just about, maybe it was slightly below. I think it was just below 4,600, maybe 450, 1095, something like that. So a $60, a 3.5% move up in gold. Silver did even better, was up 4.85%. We closed above 94, about 94.40 in change, and we traded, I think, above 95.5 in a day. So that's the new record high. I mean, we were actually closer to 100 than we were to 90 in silver. So big move up in gold and silver. And in fact, foreign stock markets, in terms of US dollars, did pretty good. I mean, some of the European names were down, but a lot of the emerging market stocks in Southeast Asia and South America were very strong, had positive days. So it was a good day if you were invested in overseas stocks. If you own precious metals, if you own mining stocks, emerging markets. It was a horrible day if you owned US stocks. And of course, if you own Bitcoin, which also tanked even more than the stock market. Bitcoin is now back below 90, I mean 90,000. Not 90, although it will be back below 90 eventually, but right now it's below 90,000, trading around 89,600. It was about 95,000 last week. In fact, Michael Saylor announced on his X page this morning that Strategy spent another couple of billion, more than 2 billion, buying more Bitcoin. He's already down over 100 million on it because his average price was over 95,000. Somehow he managed to buy the high. Now, I don't think that's a coincidence that he bought the high. I think his buying is what made the high. In this video, the discussion dives into a rapidly unfolding shift in the global precious metals landscape, one that looks very different from previous cycles. Recent reports suggest that major U.S. banks may have quietly reversed course, covering massive short positions in silver while accumulating large amounts of physical metal. If accurate, this leaves select European institutions increasingly exposed as prices rise, creating a fundamentally different kind of squeeze, one rooted not just in markets but in national strategy. The conversation expands beyond banks and charts into the realm of global sovereignty. Gold and silver are no longer treated merely as commodities, but as critical monetary assets. From the expansion of the Shanghai Metals Exchange to the integration of gold settlement across Belt and Road trade routes, physical metal is being embedded directly into international commerce. Digital currencies tied to real gold convertibility are reducing reliance on the US dollar and treasuries altogether. As gold and silver push to new record highs, the contrast across asset classes becomes stark. Precious metals, mining stocks, and emerging markets show strength while US equities and Bitcoin struggle under pressure. This divergence reinforces the idea that capital is rotating not randomly but deliberately toward tangible assets and away from financial abstractions. Now, let's get into the interview. That I thought that the action in the mining stocks was very constructive to a rally this week, because even though gold and silver finished down on the day, gold was down about 20, 30 bucks. Silver was down a couple of bucks. The gold stocks all rallied and the silver stocks rallied. So that, to me, it looked like investors were starting to realize that it doesn't matter if gold and silver go down. These stocks are so cheap, even if they go way down, which they're not going to do. And some of the stocks had really good days today. Just as an example, my best performing gold stock was I Am Gold. That one was up 15.5% today. Of course, it's at a 52. We actually own that. It's one of our top 5 holdings. Not just do we own it in the gold fund, it's one of my top 5 holdings in the Euro-Pacific International Value Fund. which, by the way, will be probably the #1 fund in its category. Year to date, out of over 300 funds, in part because we do have some gold stocks as part of the portfolio, one of them being I Am Gold. So that one was up 15.5. My best performing stock on the day that I own myself is a small silver company, which actually we own in the gold fund too. But Silver Crown Royalties was up 40% in one day. They'll be on a blockchain network. You'll get rid of checks. You'll never write a check again. Get rid of wires. You'll never do that again. It's like Venmo. It's like Zelle, but when that money moves, it has to be attached to a stable coin. That stable coin will move. The backing of that stable coin, which is 1-to-1 to the dollar, is primarily U.S. Treasuries. The interest is not transferable. So what is that going to do? That's going to create, first of all, the buying of these stable coins, which is backed by treasuries, push rates lower synthetically. They're going to push rates down any way they can, and they take the proceeds of those, which if I owe you money and I send you something via a stable coin, neither of us can take the interest that is attached to that stable coin backed by treasuries. What are they doing? Buying gold devalues the dollar, pushes gold up higher. And that's when Judy comes in. And if she's right, and Trump does back the back end of the bond market to gold at a much higher price in 30 years, we owe that amount to gold. We owe $1 million on a bond that's $1 million, is we owe $1 million in gold, 0 coupon, no interest. You bring back manufacturing at a 0 upfront borrowing cost into a massively devalued dollar, and you pay gold $1 million worth. Well, who knows what it will be back? In this video, veteran investor Peter Schiff explains why recent price action in gold and silver mining stocks may be signaling something much bigger beneath the surface. Even on a day when gold and silver prices pulled back, mining equities moved sharply higher, an unusual divergence that often appears early in powerful rallies. According to Schiff, investors are beginning to recognize that many gold and silver stocks remain deeply undervalued regardless of short-term metal price fluctuations. He points to standout performances from both large gold producers and smaller silver companies, noting that capital is selectively flowing into quality names with strong fundamentals. This kind of rotation suggests growing confidence that precious metals are entering a sustained bull phase, not a speculative spike. When mining stocks rise while metals pause, it often reflects long-term positioning rather short-term trading. The discussion then widens to the macro backdrop driving this shift. Schiff outlines how financial innovation, stable coins, and treasury-backed digital systems may ultimately suppress interest rates while accelerating currency debasement. As yield is quietly stripped from the system, gold increasingly becomes the asset absorbing that lost value. In this environment, tangible assets and companies tied to real production stand to benefit the most. If you found this helpful, like, share, and subscribe to the Metal Bar. Turn on the bell so you don't miss any updates, and comment below to share your thoughts on it. Appreciate you for tuning in.